All right. Well, thank you for joining us for this month's webinar Wednesday. We appreciate everybody hopping on. Today, we actually have our very own Amanda Harvat, which I'm super excited for. She's going to go over the tax advantages of life insurance, and annuities. If anyone would like a little bit of a deeper dive, we did just have a pretty informative meeting with John Hancock. That we can share out that webinar link that you can go back and watch that and really dig into some notes. So I'm going to let Amanda take it away.
To visit websites that contains identity theft virus.
Good morning, everyone. I'm going to get started here just so I have an idea before I bring up my presentation here. How many of you are currently using life insurance in your planning, whether you're a financial planner or insurance planner? Excellent. Excellent. So this is going to kind of be a higher level overview. You may know some of this information already, but it's always good to go over the basics, and maybe something will come up that maybe you haven't thought of before. So let me go ahead and share my screen. Can everybody see my screen?
Yes, you're good, Amanda. Yeah.
Perfect. All right, let's see here. See if I can get this into full size. Is that showing as like a full size presentation there?
Now it's just showing your blank desktop.
Oh, okay. All right, we'll do this then. All righty. So scroll down here. So the first things we're going to talk about are
it's still showing your blank desktop.
Okay.
Now, attention, the 20s, cold Thursday. Few flakes in the morning, then clearing in the afternoon. Temperatures in the.
How's that?
That's good.
Okay, sorry about that. All righty, so we'll get started here. First thing we're going to talk about are the tax-free advantages of life insurance, and that is typically going to be the death benefit. When we're planning for, either an estate planning or whatever that might be, beneficiaries will generally receive death benefits free from any income taxes, estate taxes, and they can't be pursued by the insured's creditors. So unless somebody has joint accounts where maybe they're co-signers or they jointly hold a mortgage, if a debt is solely held by the insured, creditors can't pursue a life insurance death benefit to pay off those debts, which is a really great advantage. Especially when you're talking about, somebody who might have significant debt or, complex finances, that death benefit is going to be accessible to the beneficiary almost immediately. So they're going to be able to, pay off jointly held debts. They're going to be able to use that for final expenses. And let me scroll to this here. This applies to all types of life insurance. So this is for term, permanent, and even group coverage is not going to be able to be touched by those income taxes or creditors after a death occurs. Life insurance also has quite a bit of value in the fact that it grows tax deferred. So when you have a permanent life insurance policy or product, you not only have the advantage of the tax-free death benefit if the insured were to pass, but as you're paying those premiums, you are also contributing to a cash value that grows tax deferred so long as the policy remains in force. So when you're creating a financial plan for somebody who's in a higher tax bracket during their working years, so let's say they're a doctor or, software developer, whatever that might be, they're going to be high earners in their working years, but they might not need that high of an income in their retirement years. They might not need to make such high withdrawals in their retirement years. So they're possibly anticipating to be in a lower tax bracket. That's when these strategic accounts, whether it's life insurance or even an annuity, we'll get into that later, can be used in a similar fashion to a 401k, where you're seeing that tax deferred growth. This applies to permanent life insurance products only. Obviously, many term products can be converted into permanent products, but until they're converted into either a whole life or an IUL or something similar in the permanent space, that's when you'll see those cash accounts that have this tax deferred growth. Does anybody have any questions about the tax deferred advantages of life insurance?
Yep. I do have a quick question. I just had a client pass away, and the money went to the wife. And then a month, 2 months later, 3 months later, she gets a letter from the IRS saying that her dead husband owes like $30,000 in income taxes. Is she liable for any of that money, or any of the death?
So they don't have any claim to the death benefit, so they can't just, take that from her. That may be considered an inherited debt. So since she was the spouse, that might be considered an inherited debt that she does have the obligation to pay. But I can definitely look into that, because I know there are obviously inherited debts that can occur, but they can't come after the death benefit, I guess I should say. They can come after her, and she can choose to pay that debt with a life insurance death benefit, but they can't just take that from her.
Oh, okay, thank you.
Yeah, absolutely. Any other questions? That was a good one. Thank you, Cliff. I appreciate that.
It just happened a week or two ago.
So when we look at some of the retirement strategies, we mentioned the tax deferred works similarly to a 401k. But something else that we can take into account is the withdrawals that are tax advantaged. So that's when we're taking a tax advantage withdrawal or a loan from a cash value policy during our retirement years to either supplement retirement income, or even, before retirement years, if we want to pay for our children's college expenses or a major renovation on our home or anything like that, any unexpected expenses we can use for this too. This is a really great way to kind of take away that tax burden on a large withdrawal of money. Whereas if you were to take a withdrawal from, let's say, in a retirement account, you would have a tax burden at that point, especially if you were before retirement age. So this is a strategy that we use, especially in planning for down market years. When you're taking your withdrawals and you need that source of income in your retirement, instead of taking money from something that's tied to the market as a whole, you can take money from your cash account, your cash value account that's not tied to the market, which is a really great advantage. And I have another slide here that'll kind of illustrate that a little bit better. But this applies also to permanent products. So again, you can convert a term product typically into a permanent product, but this particular strategy is saved for whole life, IUL, etc., that it is gaining a cash value. When you are doing these either withdrawals or loans, something to keep in mind is that additional premiums might need to be paid to keep that policy in force if you're taking cash value out. If you were to pass away while you have a loan on one of these policies, also, that death benefit for your beneficiaries is going to be lowered by the amount of the loan that you had out. So that's just something to make sure that people are aware of if they are using this strategy. So here's a great illustration of kind of how this might work in retirement. So this chart up here, can you see my mouse? As I'm circling? Okay, perfect. So this is an illustration of somebody who is taking withdrawals from just a traditional IRA. And you can see this is from years 1977 to 1996. I apologize, it's not recent data, but just for illustration purposes, you can see that as we get down here to, so age 65, the market was down. They took their withdrawal of 120,000. And then when we get down here to age 82, once again, the market was down. They took their full withdrawal that they needed. Had they been able to supplement that income, instead of taking it from the IRA, taking it from a cash account, a tax valued or a tax advantaged cash account, you would see that over here, we took $0 out during that year, after that year of the market being down. And then we come down here a little bit further and we look at age 83 when the market was also down, and we took a significantly lower withdrawal. Now, just before I move on, does anybody know why we had to take a withdrawal from the IRA here during this age 83? Yep, RMDs. And that's why we were able to forego the withdrawal this year. And if you look at the ending balances, and this is evident in the chart as well, you can kind of see how this grew over the years, but those ending balances are significantly different. So just by taking those 2 years of withdrawals from their IRA, when the market was down, they ended up at age 84 with a balance in their IRA of $1.4 million, almost $1.5 million. Had they left that money in there during those down years, and utilized a cash value life insurance or a cash advantage or tax advantaged account for those withdrawals, they would have been able to maintain their presence in the market, and they would end up with $2.8 million in that account. So that's pretty significant, how that works and how that can grow over time. Does this make sense to everybody? I know this is a lot of charts and graphs. Does anybody have any questions about this? Great. I'm glad that made sense. That's always very impactful. I always love to see how this plays out.
And that was only showing just leaving it alone for 1 year, leaving the IRA alone at age 66, correct?
Yeah, so it was age 66 and age 83. So they took a withdrawal of 123,600 at age 66, and then they took a withdrawal of 204,292 at age 83. When they, didn't take that withdrawal, and they used their cash at age 66, and then they took a much lower, they took their RMD.
Oh, that's what that's the difference then. It just took a lower one at age 83. I was looking for a couple more zeros, but I understand now.
Yeah. I know it would be nice if we could take a zero that at that age, but unfortunately they're going to make us
That's the RMD. They got to take the RMD. Got it. I got it.
Yep.
Yep.
So, and as we get into annuities here, this works similarly, the tax deferral that we talked about with a cash value life insurance. The value here is that this isn't underwritten by health. We see a lot of older individuals take advantage of these annuities, especially at the rates that we've been seeing lately. So they might have been in, or they might just want safe growth, relatively conservative growth, guaranteed growth that's tax deferred. The advantage here is that when you're looking at that conservative growth, your other option might be a CD, right? The problem with a CD is that you are taking a tax hit every single year on that growth. So you have less invested each year when you have to pay those taxes. And those CDs are actually taxed, the growth is taxed as capital gains. Whereas an annuity, the growth is actually taxed as ordinary income, which I think is an important distinction. There is a break point. I'd have to go more in depth with today's tax brackets, but there is a break point where at a certain income level, it is more advantageous to pay ordinary income tax as opposed to capital gains tax. So, you know, that's going to be on a client by client basis, but that's very important to take into account when you're evaluating, you know, something to put into a conservative growth portfolio. Does anybody have any questions? Oh yeah.
I thought interest from CDs is taxed as ordinary income. Like bank
No,
accounts.
so that's taxed as capital gains from my research and understanding. Yeah, so it's interesting, and like I said, there's going to be, you know, for those super high earners, the being taxed as ordinary income isn't going to be an advantage for them. But you know, wherever, and obviously tax laws are always changing, but depending on where they fall on that ordinary income scale, it can be tax advantage to go ahead and have that tax as ordinary income as opposed to capital gains. Anybody have any questions in regards to not just annuities, but anything else that I presented today? I'm like I said, it was a very high level overview, but I think it's good to go, you know, have a solid foundation and go over these basics every once in a while.
I do have a question on annuities.
Yeah.
Let's say you've got an old physician or something like that, and he says, well, I can just put my money in a Vanguard S&P fund, and I'll be better off than if I put money in a variable annuity S&P fund. Is there a mathematical proof that one's better than the other?
I wish there was like an easy rule of thumb for that, but it really would be dependent on so many different factors. You know, what is he taking in terms of withdrawal? What is his, you know, risk tolerance? What is he, if he's, you know.
Yeah, I'm just saying, you know, the annuity wrapper.
Yeah.
You know, an S&P fund in an annuity wrapper that, you know, is tax deferred, but you pay ordinary income taxes when you pull it out, versus just letting money compound out and being reinvested in a taxable S&P.
Yeah,
and
I mean,
if he takes money of a taxable S&P, is that taxable ordinary income too, or does it have different taxation?
So that would, it would, if he was putting it in just like a mutual fund account, just a, you know, an investment account, or is it a retirement account?
Non-qualified.
Okay.
Yeah, both a non-qualified S&P fund versus a S&P fund inside of a variable annuity.
Yeah, I think it would come down to a similar situation. You know, when he's taking those withdrawals, that's going to be taxed as capital gains. That won't be taxed as ordinary income. And anybody, if I'm misspeaking, anybody jump in and correct me, but I'm fairly certain that would be kind of a similar situation with this CD situation.
Yeah, I just looked it up as well just to verify, and it is if you sell any kind of stock for a profit, so if you're in the market at all, you will have to pay capital gains tax on any kind of profit.
Yeah, but that's a mutual fund though. It's not just owning 500 stock.
Yeah, it's like
a S&P 500. And
yeah, even a portfolio of stocks like that, or a slice of a portfolio of stocks like that, like a mutual fund, it would still be considered, you know, capital gains in that regard.
Out of a taxable mutual fund. Okay.
Interest on CDs is income and is taxed as income.
Yeah, it's not capital gains.
Right.
So in other words, I ran a case like this with a doctor, and he goes, well, I like the S&P, it's cheap, and, Vanguard has a good deal. And, he's still probably making 600,000-700,000 a year.
Mhm.
And he goes, well, I'm going to put my money in S&P fund. And I think I'm better off than having an annuity, because when I pull money out of S&P annuity, I got to pay income taxes on it. But I just wanted to verify that an S&P fund is, ordinary income taxes, or is it, capital gains?
Yeah, an S&P fund, if he's just doing an investment account, that would definitely be capital gains. And if he's a high earner like that, it's probably going to be a better bet for him to not do an annuity, because that's going to be in his higher tax bracket. So
Yeah.
I think the break point, and again, I have to look at today's tax rates and everything like that. But I think the break point
sell a lot more annuities.
50,000.
Yeah, that would help me sell more annuities if there was a, mechanism to measure the taxes on one versus the other, or break point.
Yeah, absolutely. Absolutely. I can do some more research on that and send that over to you.
Sure.
Any other questions? I apologize if I had a mistake in there regarding the CDs. I will do some more research on that as well. I don't want to give any misinformation.
No, this was great, Amanda. All good valid points to remember. And even that one chart showing the difference of letting your money sit versus withdrawing it, having a secondary source for withdrawals when you need it. It just shows how much of an impact that can have throughout the years. So that was really, really impactful. So thank you for sharing that with us.
Yes, thank you so much. I really appreciate the opportunity to share. And if anybody has any additional questions, or if you want to, discuss a particular case, please feel free to reach out to myself or Kelly.
Yeah, absolutely. We also have Dana on here with us today. Dana is one of our KAFL teammates. She actually runs our point of sale program and our KAFL Direct program. Dana, do you want to tell everybody kind of what you do and what that looks like for advisors in that role? This is fairly new to KAFL as of last year. We're getting to where we're just starting to talk pretty openly about it. So we didn't want Dana to get too bombarded right away. But I'll let her kind of go over what that model looks like within KAFL. We're pretty excited about it. So Dana?
Yeah. I used to be in the brokerage role. And then what I was finding is that a lot of agents were getting fed up with how much training there was involved, especially in New York cases, how much paperwork was involved. Reg 60, Reg 187, these were all unique to New York cases. And so a lot of agents that were primarily focused on investments as their primary source of income, or on P&C types of insurances, just didn't have time to do all those things that were required of life insurance, which was not a big part of their practice. So I started just on individual basis, offering to do that for the agents and just take over the role as the agent for them as an extension of their business and work directly with their clients. And so it became such a popular offering that we decided to create a whole department around it. So that's what I do now, just 100%. Is any referral that you give to me, one of your clients that say is talking to you about their investments, but is interested in life insurance as part of their portfolio, but you don't want to make that sale or have to do the training or keep up with the regulations, you just hand that client off to me. I do everything from the fact finding to the quotes, to the application with them, to the requirements with them, to the delivery. So everything from start to finish, and then you would get a referral fee for that referral. And that referral fee is capped by law at 25% of agent commission or agent compensation. So it's not meant to be a big money maker for you, but just another source of income that is, requires no overhead, no additional resources on your part, but can add income to you on top of what you're already doing in your main practice. So it's proved to be very popular. Like Kelly said, I'm at sometimes completely overwhelmed with how many people are being sent my way, but it's wonderful to see, and I'm always happy to do it. So it's not meant, and one thing I do want to stress is it's not meant for individual one-off. Well, I don't feel like doing this case today. I'm going to give it to Dana, but I'm going to do this case tomorrow. It's meant to be like all or nothing, as just a part, an extension of your business, not just one-on-one or one-by-one cases. So it would be a partnership between us. That's how I like to say it. So I have one agency that actually has me on their website as their resource for life insurance. So anyone that's interested just contacts me directly. And so that works well for them. They get checks for commissions for business they don't even know that I'm doing.
Thank you, Dana. Thanks for hopping on today and going through that. I think it's a really awesome thing that KAFL's offering now in that direct program. So
yeah, and if anyone has questions in more detail about how it works or how it looks for your individual business, you know, just contact me. You can just call the KAFL number and ask for me, and I'll help however I can.
and I'm going to include your email in the chat, Dana,
Sure.
so that everyone has it, if that's okay with you.
Definitely.
Okay, so that if there are questions, they can reach out to you. I have also, again, I put the link to the John Hancock webinar that we had on tax ready retirement is there. So if you want a little bit of a deeper dive, it was a great presentation. So feel free to hop into that. Are there any other questions before we end today?
Yeah, we can grab those charts, can't we? The charts you just showed.
That Amanda shared? Yeah, I think
Yeah.
we'll be sending those slides out with this recording once it
Okay.
downloads. So
Nice.
we'll get that over to
Nice.
everybody with a little thank you. So we'll include those.
Nice. Thank you.
All right. Thank you. I hope everyone has a great day.